Money at Work Continuing Education Series. Today's episode concentrates and centers around what's the best strategy to trade crypto and why have a crypto investment strategy. With the birth of a new asset class, cryptocurrency has become very popular around the world over the past few years. While it is very popular, there are some risks involved in trading or investing in digital coins you need to be aware of. And just a quick disclosure, this video is for information, educational, entertainment purposes. It's not a recommendation or advice to buy cryptocurrency. Having a well-developed and proven strategy while trading or investing in those cryptocurrencies is very important for trying to make profits and getting a return from that market. And it really just goes back to your risk tolerance and your final goals of trading or investing so you can choose the right strategy that fits your trading ventures and goals the best. Earning profits through crypto trading is all about making the right predictions about price fluctuations in the market. And for this, you've got to have a strict set of rules and principles that's going to govern you along the way and provide you with a blueprint or help. Similar to trading equities and commodities, crypto trading is fraught with risk as well as pitfalls. In order to get long-term benefits from trading or investing in crypto, market enthusiasts need to develop strategies that can make trading fun as well as safe at the same time. Let's start by going through some strategies that can help you get some decent returns. First of all, smart money concepts, smart trading concepts. One of the many crypto trading strategies, one of the most popular is the smart trading strategy. When using this strategy, you're mixing different smart orders such as stop limit or trailing stop losses to get you into a defined approach to the market. This trading strategy often tells traders, what's a good risk as well as a good return control, which can help you better plan and monitor your positions. There are different types of combinations that you can use. One of the easiest is combining taking profits and a stop loss. When you use this strategy, you're only required to place two orders. The stop loss is used to limit the loss if something goes wrong in the trade, in the market. On the other hand, you take profits is used to make sure that you get the profits whenever the market reaches an aimed condition that you preset. You can also combine multiple take profits with stop losses, which is used to take your strategy, kind of to another level, combination. When you use two or more take profit strategies, you're able to spread the risk of trading while maximizing your chances to make decent returns and good profits. While it's very similar to the previous method, it simply makes everything easier and less risky because you're taking the emotion out of what you're trying to do. You're making data-driven decisions. Next up, hold on for dear life. Known as one of the most effective strategies in the marketplace today, hold on for dear life is used by a lot of crypto traders each and every day. With this strategy, both risk and possibilities are basically unlimited. You can end up losing everything you invested or winning huge returns with the strategy, depending on what the end crypto does. One of the best things about hold on for dear life is that you need to just buy the digital currencies without setting the take profit or stop loss. You are investing for the long term or for whatever set date you've predetermined. This trading strategy can either make or break you, because of which it is very important to really think about the risk before deciding to use it. Because it's so risky, it's very important for traders to have a special mindset. Basically, you're required to be able to trust your instincts and decisions. Otherwise, it's going to be hard to make good profits with the strategy, once again, getting emotional about things. Very important thing to understand is only invest. This is very, very important. Only invest the amount of money that you can afford to lose when using this strategy. While risky, this strategy is also known as a way to avoid the volatility of the market and survive those short-term price movements in crypto trading. Basically, what you're doing here is trying to predict the future best you can, putting some chips or some money behind, owning a piece of that prediction. Next up is the dollar cost average. When it comes to finding the perfect entry and exit point in the crypto market, it's best to assume that the timing of the market is next to impossible. So rather, a sound way to go about investing in cryptos is dollar cost averaging. Same thing we do in other asset classes. Dollar cost averaging refers to investing a fixed amount on a regular interval. This strategy helps investors do away with the cumbersome job of trying to time the markets, which is basically impossible, and they build wealth strategically in the long term. However, exit strategy could also be tricky in this style. It requires the study of market trends and understanding of market cycles. Reading technical charts can also help you, approach and understand the appropriate time for an exit. Crypto investors should monitor oversold and overbought regions before, making a move in that market. Next up is day trading. This trading strategy is just very simple. It involves taking positions and exiting those positions on the same day. The aim of the trader is, while adopting such a trade, is to book the profits amid intraday price movements in the cryptocurrency of their choice. For a successful trade, investors often rely on technical indicators to figure out entry and exit points for the particular crypto, once again, within the same day. HFT, which is high frequency trading. So this is a kind of algorithmic trading strategy used by some advanced traders. This involves algorithms and trading bots that help quickly enter and exit a crypto asset. Developing such bots needs understanding of complex market concepts and strong knowledge of mathematics and computer science. Therefore, it's more suited for those advanced traders over the beginner traders. We've gone through some different types of strategies here, but my favorite is to build a balanced portfolio. Crypto, still is in an evolving stage. While several countries have welcomed trading in the cryptos, some are skeptical about it and even banned it. Central banks across the globe are working on better ways to regulate these digital currencies, and therefore, trading in the cryptos is often a risky affair as we evolve. However, there are strategies that can help investors steer clear of what we call extreme volatility, and that really is all about building a balanced portfolio that includes a variety of cryptocurrencies that can go a long way in beating, an individual crypto in its volatility. Besides, investors can also maintain a fixed amount of regular investments in different cryptos. This will increase the risk appetite in a systematic manner and will help your portfolio to yield those favorable returns in the long run. Like we said, this is a new birth of an asset class. It's still evolving, so you want to understand the risk as well as the opportunities getting in, and then attach yourself and your style, whether that be investing or trading, to your A, risk tolerance, and your B, final goals like we talked about earlier. You want more tips on money, millionaire habits, investing, entrepreneurship, millionaire mindset.life. Stretch your thinking, create your vision, and achieve.